Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello. As always, we're going to run through the most important charts and themes in markets and investing. Another big show. We have a lot to discuss, a lot going on in markets. We have a little bit of a pullback, first time since March. And "'Tis but a flesh wound" is the title here because it's a pretty minor pullback. It only feels like a lot because we haven't seen very much volatility at all over the past few months. So let's dig into it here. We have the S&P 500 index down a little over 5% from its peak in July. And for a number of months, we hadn't seen a pullback bigger than 3%. So pretty steady move higher from the low in March. People were worried about the banking crisis. They soon forgot about that. Market rallied for months after that. And now we have the first meaningful pullback here. Not as big as the pullback we saw in February and March, but 5% starting to get people's attention again. And what are they attributing it to? Well, there's always a reason for a pullback. People are talking about China, slowdown there, potential problems that might cause. You have obviously rising interest rates, and we'll talk about that in a little bit. So take your pick, any number of things. As always, there's no way to pinpoint one thing. It's really just a change in sentiment, and sentiment can change on a dime, as we'll talk about as well. Investors were getting pretty bullish a few weeks ago, and we covered that, and now they're a little bit less bullish. But digging into the pullback this year, is it anything unusual? Well, not at all. If anything, it's been a pretty mild year in terms of drawdowns. We have data going back to 1928 for the S&P 500, and the median year has an intra-year drawdown of 13%, and the max drawdown this year only 7.8%. That was in that February-March period. So pretty mild year. S&P 500 still up over 13% on the year, even with this 5% pullback. And that's not unusual. You see many years where you have big intra-year declines and the market turns positive. But as compared to last year, still obviously very mild year. 25% was the peak to trough intra-year drawdown in 2022. And the max so far this year, only 8%. And this pullback, only 5%. So if we look at the tendencies, and this is what every equity investor should look at and be focused on, these types of corrections and pullbacks are commonplace. They happen each and every year. If it's a bigger correction, it's less likely to happen, but still, you should be expecting it every few years. Let's just dig into it here. In terms of intra-year declines, 5% decline on an intra-year basis happens almost every year. 10% you're looking at every other year. 20% every 4 years. We saw that in 2022, and 50% pretty rare in terms of just a single year drawdown. In terms of bear markets, every 4 years you see that 20% decline, 30% less common, 50% every 20 years or so. So if you're a long-term investor, you should be expecting corrections. You should be expecting bear markets. They're just a part of the game, because without that risk, you're not getting that risk premium. You're not getting that reward that equities tend to give over the long term. And we tend to forget that during periods of calm and periods of quiet. So the last 5 months, a lot of investors may have forgotten that risk still exists in the equity market. Now they're getting just a friendly reminder. So if we dig into the big stocks, the ones that everyone looks at and talks about, most of them are having a bigger correction than the broader S&P 500. And I think that's having an impact on sentiment here. If we look at things like Tesla, down over 25% on this recent pullback. A few stocks are holding up well if we look at Amazon and Google, but most of the big names are down double digit or more, Apple being the biggest company in the S&P 500, and down over 11% on this recent pullback. So there was a lot of euphoria, if you want to call it, in terms of tech. We talked about the rise in valuations, the multiple expansion, the AI mania that we had for a number of months. That seems to be cooling off a little bit, but relatively minor declines given where we are year to date still. So we're looking at all of these major, biggest companies in the S&P 500 up over at least 30% this year. You have Nvidia still up 196%, leading all S&P 500 companies. Meta still up 135%, even with Tesla's sizable pullback still up 75% on the year. So certainly not wiping out what we did for months here, which was trend higher. It's just a normal pullback so far. So if we look at the major indices and we compare the S&P 500 to the NASDAQ, you can see bigger pullback in the NASDAQ and then a bigger pullback here in emerging markets. And then you have the ARK Innovation ETF, which is obviously the highest growth names, getting hit the worst here during this recent pullback, down over 20%. So what's driving that? Obviously fears in China driving emerging markets, but the tech portion seems to be the fear that dominated in 2022, which we didn't see for most of this year, which is that fear of rising rates are going to cause problems in terms of investor sentiment. They're not going to pay as high of a multiple. So we're seeing that multiple compression here due to those rising yields. And we'll talk about that. We have the 10-year and 30-year yields hitting their highest levels in quite some time. So investor sentiment, it's always amazing how quickly this changes with just a minor pullback in price. So we talked about active managers here, the name exposure index. So looking at average exposures of active managers a few weeks ago, they went levered long. And what we were saying at the time is that might not be an outright negative signal, but it's certainly not a positive. You don't want to see them being levered long, particularly when they were had very little exposure on the equity market last October when the market was substantially lower. So after a huge, enormous run up, they were levered long. Now, very quickly, this is interesting, they're below 60% in terms of exposure. So this 5% pullback caused them to move from over 100% exposed to a little bit less than 60%. So these can swing wildly. Now we're back, a little bit actually below the average exposure if we're looking at the last 15 years or so. So if we're going to look at the bull-bear spread here, we're seeing something similar. We saw a shift to a bullish bias here where the bulls outnumber bears by the widest margin that we had seen since November 2021. And now very quickly with that 5% pullback, you're seeing fewer bulls and more bears start to emerge. So nothing extreme here in terms of definitely a 5% pullback has not caused people to become bearish by any means, but you're getting back to a more neutral sentiment very quickly on that decline. So let's switch gears and talk about the bond market. This has really been, at least the past week or two, been, I'd say, the biggest source of the market's fears and worries is that rapidly rising interest rate. So the market was kind of settling into the idea that the Fed was going to be on hold and interest rates were going to be higher than longer, but they're not appreciating longer term yields quickly moving up the way they've been moving up in recent weeks. So now we have the 10-year yield 4.3%. That's the highest we've seen since December 2007. So it's finally joining the shorter term yields, which were hitting their highest levels in a long time. Now, finally, the longer end are starting to move higher as well. And why are investors worried about that? Because they're thinking, well, perhaps that's a sign that market participants are saying that inflation is going to be higher for a longer period of time as well. Now, here's the interesting thing for bond investors. You should really look at real yields. So how are you being compensated for the levels of expected inflation? So if we look at the 10-year treasury yield and we subtract out inflation expectations, so the 10-year break-even inflation rate, we're seeing the highest real yields, almost 2% real yields after adjusting for those inflation expectations since July 2009. So not only are bond investors who are buying today being compensated with higher yields, which tend to lead to higher future returns, they're also getting a better return adjusted for that expected inflation. So much better position for bond investors than where we were a few years ago. But this has come as a result of the pain in the bond market. So we've seen these massive price declines in the prices of bonds as these yields move higher. What we're looking at here is 10-year treasury bond total returns calendar year going back to 1928. interesting thing here, we're on pace here for a third consecutive down year for that 10-year Treasury bond. That's something we've never seen before in history. During the 1950s, we had two straight down years, twice during the 1950s. The magnitude was not significant, not even close to where we are today. So this is not only the biggest drawdown for bonds in history and the longest drawdown at 3 years in running here, it's now perhaps going to be the first three consecutive negative years for bonds. So the good news for new bond investors, well, you're going to have better future long-term returns. The bad news for existing bond investors is that has caused a lot of pain over the last few years in terms of what your average bond fund is doing. So in the short run, changes in yields determine everything in terms of bond performance. In the long run, it's that beginning yield that determines bond performance. As you can see here, there's a almost 1-for-1 correlation between the starting yield and the future 7-year return on a bond. And this is just looking at the Bloomberg aggregate, so the aggregate US bond market. And when that 10-year Treasury yield is very low, your expectation should be a very low return. The lowest we ever saw was in 2020 when the 10-year was well below 1%. So your expected return over that next 7-year period for bonds is going to be extremely low, below 1%. And what we're seeing so far is a negative return for bonds since then. But remember, it takes 7 years. So, in the short term, it's just adjusting, the price is adjusting to higher yields. Eventually, that coupon is going to come back and you'll make that very low rate of return. But the good news today is the bond market expectations should be moving up. So now we're above 4% for the 10-year. We're in that third decile. So you're looking at anywhere probably between 4 or 5% in terms of your return expectations for bonds over the next 7 years. Now, over the next 7 months, who knows? If bond yields goes down, you're going to see bond prices shoot up. If bond yields continue to go up, let's say the 10-year goes to 5%, where you're going to see continued weakness in the short run. But we know if you're a buy and hold bond investor over the next 7 years, you're going to see much better returns than we've seen, the highest prospective returns that we've seen since 2007. So that's the upside of downside. That's the good news for bond investors that are coming into the market today. So let's talk about the economy. The Conference Board puts out this leading economic index every single month, and now they're saying it's down for the 16th consecutive month in July. And we talked about this in the last few months. They had been predicting a recession in the third quarter for the US, but we were saying a lot of the data so far in the third quarter doesn't look like a recession. Or are they going to change their outlook? Well, here they are changing their outlook. They're now saying a recession is going to be short and shallow. It's going to start in Q4 2023 and last only, I guess, to Q1 2024. And so this is important for investors because it should show you how difficult it is to predict these things. Is a recession going to start in Q4? Who knows? They might push that out again. How do they know it's going to be short and shallow? No idea. So take this with a grain of salt, but interesting to see that leading indicators are still pointing to a potential slowdown and downturn. Not the stock market, as we've said, the stock market seems to be the exception, but other leading economic indicators, such as the yield curve, still suggesting we're going to see weakness ahead. This is the spread between 10-year treasuries and 3-month treasuries, still in that highly negative territory, saying perhaps there's going to be economic weakness and then the Fed is going to cut rates because of that. And a lot of people saying, well, the yield curve's not working anymore. It's broken. It inverted last October. Where's the recession? It should be here already. But this is very much in line with the historical track record of this yield curve indicator, where on average, it could take a few years. And, we don't know how long it's going to take, but it only inverted last October and it hasn't even been a year yet. So this is well within the historical probabilities in terms of will there be a recession within the next few years. Now, this is not a timing indicator. As you can see, there's a huge variation from one cycle to the next in terms of when the yield curve first inverts and when the recession starts. But it's way too early to say throw this out the window. This thing is broken now. A lot of people are saying that. They say that every single time. They said it the last time the yield curve inverted, and they're saying it again today. They say it every single time. Now, why is there this lag? And a part of it is because there's a lag with monetary policy, and the Fed now has hiked 525 basis points. It takes time for that to filter into the economy. It takes time for that to show up in terms of hitting consumer demand. And perhaps it's just a matter of time now that we'll see one. So the leading indicators are still there with the exception of the stock market. And only time will tell if this time is different. I think it's too early to say that it's broken. So in terms of indicators suggesting that perhaps we are seeing the beginnings of a slowdown, industrial production, again, decline. This is the second year-over-year decline in a row that we've seen for industrial production. We're seeing weakness as well in retail sales, and on a inflation-adjusted basis, another negative year-over-year print, and even on a nominal basis, pretty weak at 2% growth year-over-year. So consumer, obviously, biggest part of the economy. Retail sales is just one component of consumer spending, obviously. We talked about consumers are still spending like crazy on things like travel. That has been a big boost to the economy. And obviously the government, the US government is borrowing and spending just an enormous amount of money in the past year. That's supporting the economy as well. But this is something I'm going to keep a close eye on in the coming months to see if this is just a dip here and we're going to go back up in terms of retail sales. Obviously, we had that explosive move higher after the 3 rounds of stimulus where we saw just the biggest increase in retail sales that we've ever seen. So a lot of people saying, well, this is just an adjustment from that period. You're comparing to those periods where there's just enormous growth. You shouldn't compare to that, perhaps that, but I think also it's a function of the consumer is feeling some more strain than they were feeling. We talked about the reasons for that, wages not keeping up with inflation for 2 years, and other reasons as well. Now, this is all in the midst of a job market that's still very strong. So ultimately, if people have a job and their wages are increasing, they're still going to be spending money. And so the biggest factor driving retail sales historically is employment. So if we see unemployment start to move up, that's obviously going to have be a much bigger factor than anything else. So we haven't yet seen that just yet. We're still expecting to see jobs growth at least for the next few months. So if we talk about some of the earnings reports here for retailers, we got one from Target and Home Depot, and this kind of confirms what we're seeing with overall retail sales. Just a little bit of a slowdown here. So negative year-over-year revenue growth for Target and Home Depot, and both of them talked about kind of a shift in terms of what the consumer is buying, fewer discretionary items. Home Depot once again saying fewer big projects. And so there's a debate, well, is it just that people did so much of that spending back in 2021 that this is just a natural adjustment to that, or is it something more where the consumer has less run room, where they've ran through more of their savings that they built up from those stimulus programs, and now they're going to adjust down to a lower level. So that remains to be seen, but clearly retail sales environment is something to watch in terms of the health of the U.S. economy, and jobs is going to have to drive that. It's, as long as we're seeing 4% plus wage growth, and we're seeing that outpace inflation, which is the good news. It has been the last few months. Then you wouldn't expect this to collapse. The real problems are going to arise when we have that unemployment rate start to move up. So let's talk about policy mistakes here. There's a lot of people saying, they continue to say the Fed's making a huge policy mistake. The argument now is that inflation is under control. The Fed shouldn't have been so aggressive. People are saying they definitely shouldn't be hiking rates again, regardless of anything that's happened. They're saying the inflation picture has been solved, and the Fed is making a policy mistake by overly tightening, given all of the evidence we've seen in recent months of lower inflation. And I would counter that 100%. The Fed's number one mandate is to try to create price stability. They did not follow that whatsoever throughout 2021 and into early 2022. When we saw inflation hit its highest levels in 40 years, they actually just sat there and said, no, it's transitory. We can wait. We don't have to do anything about it. And then they were behind the curve. And so they aggressively hiked rates. So these same people are saying that the Fed's making a policy mistake today. We're not there back in 2021 saying that the Fed was doing anything wrong. And in my mind, the biggest thing that the Fed did, the most culpability, is really in relation to the housing market, right? The housing market is by far the biggest consumer purchase. It's what drives CPI in the long run because it's over a third of the index. It's what people spend the most money on. And what we had in 2020 and 2021, by all accounts, if you look at home prices relative to incomes and you look at many other factors, we had, by all accounts, the second housing bubble that we've seen since 2000. So we had that bubble in the mid 2000s, and we had another one in 2020 and 2021. And what was the Fed doing during that period of time in 2020 and 2021? They weren't just sitting out and saying, okay, there's a bubble, we can't do anything about it. They were aggressively buying mortgage bonds each and every month in an attempt to drive that interest rate lower on mortgage bonds. And they were successful. The interest rate on the 30-year fixed mortgage got all the way down to 2.65%. So the Fed is in there every single month buying these bonds, manipulating the market, trying to get lower rates, and talking about we need to stimulate the housing market, we need to have higher prices would be better for the economy. And so we saw this explosion higher in terms of the money supply. We saw this explosion higher in terms of home prices. And now people are saying, well, the Fed's making a policy mistake because interest rates are too high. Housing is unaffordable. Well, it's unaffordable in large part because of those enormous price increases and that people bought homes with these manipulated interest rates. So the artificial interest rates that wouldn't have happened if just supply and demand for the mortgage market was not influenced by the Fed. You wouldn't have seen that. You wouldn't have seen it without obviously the fiscal stimulus as well. But now they're saying, well, this is too high. This is unaffordable. The Fed should do something about it. They should cut rates. Now, the Fed is trying to slow the housing market now and after the fact. So I think they recognize the mistakes, even though they may not admit to saying it out loud. I think they're recognizing that they overstayed their welcome. They shouldn't have been propping and pushing up housing prices when they were already at elevated levels. Problem is that you have all these people now stuck in these low mortgage rates, not stuck. It's a great thing, assuming they don't have to move, but they're not selling their homes. So we're not seeing enough supply to let housing prices reset. So I think the Fed probably assumed that if we had 7% plus mortgage rates, now we have the 30-year moving up to 7.09%, highest since 2002. They probably assumed if we got above 7%, we're going to see housing prices reset, and that's going to help the inflationary picture very much because housing is the biggest component. What they didn't anticipate, likely, and to be fair, I didn't anticipate this as well, is that people would just simply not list their homes, and you have this collapse in supply, and therefore prices aren't moving anywhere, and you're leading to just the fewest transactions we've seen in terms of the housing market in a long time. So this is the comparison I think that people should be looking at in terms of what went on 3 years ago and what's going on today in terms of affordability. So 3 years ago, you had that 30-year mortgage rate pushed down below 3%. You had a median existing home price at $294,000. Today, $709 for the 30-year mortgage and a $410,000 average median existing home price. And the result of this is a $23,000 increase in the down payment. That's assuming 20% down. Many are putting less than that, but assuming 20% down, $23,000 increase in the down payment need, and 122% increase in the monthly payment. So 3 years ago, the median existing home would have cost you almost a little under $1,000 a month. Now you're at $2,200 a month. So big question is, well, how is this affordable? because wages are up, I think, around 15% in the last 3 years, which is pretty strong growth, certainly from what we were seeing before that. Big part of that is obviously the inflationary aspect, but you have a 15% increase in wages and 122% increase in terms of the monthly payment. That simply doesn't work, and that's just leading to a collapse in demand like we've never seen before. So we have nobody basically able to afford the prices based on their income, based on the monthly payment. If you're paying cash, you can afford it. If you, I guess, buy a smaller house than you wanted, you can afford it, and perhaps that's part of it. But really, the big dynamic is there's simply very little supply. So if we had more supply, that would bring down prices. But if you look at this, tweet here, where is the policy mistake? Is it today at interest rates at, let's say, market levels or normal levels because the Fed is out of the market now, or was the mistake in driving up prices unnecessarily back in 2020? And my view, obviously, is it's the former. That was the big mistake. So here we have the Fed total balance sheet. You can see what they did in 2020 here, and not just the initial spike when everyone thought, okay, this is going to be a big collapse, it's going to be another depression. The Fed continued to do that even after it became clear that the economy is recovering. We're doing these massive stimulus. Why is the Fed continuing to buy mortgage bonds every single month? So now we're reversing that. I think that's a good thing. Hopefully that continues. But as you notice here, we're doing it at an extremely slow pace. So it was a big rush to come into the market and push things higher. And it's not as big of a concern here in letting it roll off. And we know the reason for that. They don't want to cause a collapse. They don't want to cause a big market downturn. But if you're looking for the policy mistake, it's not in the Fed's balance sheet coming down, which is still $4 trillion higher than where it was at the end of 2019. It was that the Fed's balance sheet increased by that $4 trillion in a very short period of time. So to be continued in terms of what happens here, but it's just fascinating to me that the Fed has never questioned on this in terms of, if you listen to the FOMC press conferences, no one ever asked this question about the housing market. It's really the elephant in the room. Why did they continue to buy mortgage bonds and create that situation when they had all the data and evidence suggest that the housing market was already on fire and prices were already at extremely high levels? So this is where we are in terms of a visual. If you're wondering why people aren't listing their homes for sale, almost 2/3 of more existing mortgages have a rate below 4%. So if that same person who bought a home in 2020 and they have an interest rate, let's say below 3% or around 3%, if they were to go out today and try to sell their home and buy a new home, well, now they're going to have to take out a mortgage at a 7% interest rate, and you have a house price that's over 40% higher than where it was back in 2020. So the math simply doesn't work because people's incomes haven't gone up, as we said, over 100%. So they've gone up, and that's been helpful, but not nearly enough. So how is this all going to shake out? I don't know, but it's hard to envision a situation where you're going to have enough demand to push up prices. But I guess the real question is when you're going to have that supply, and perhaps it's only going to come in talking about employment when we have that recession begin and we have unemployment start to go up, and then you have people saying, well, I can't afford this home, or I have to sell because of my job. I lost my job. Perhaps that'll be the catalyst. Not something you want to see for sure. I think all of this could have been avoided in saying it's not a good idea to push up prices to artificial levels. And last point on that, in terms of things that are not a good idea, probably not a good idea to increase the money supply by 50% in a 3-year period, which is exactly what we did. And you could see here the last 10 years, the relationship between money supply and home prices both up 93% over the last 10 years. So your home price has gone up, but a big part of that is simply inflation. A big part of that is simply that dollar, the value of your consumer dollar is worth a lot less. Now, for anyone who doesn't have a home or doesn't have assets, this is much, much worse, obviously, of a situation. If you don't have that built-in appreciation keeping up with inflation, and let's say you're renting or you don't have assets in stocks and you're just reliant on your income, and you have, even worse, credit card debt, and you have liabilities that are going higher with the Federal Reserve's interest rates. Well, this is a terrible situation. And anyone who hasn't yet bought, let's say, a car or a house, terrible situation. So I think a lesson, hopefully, we've learned it, is you don't want to increase the money supply so rapidly like we did in a very short period of time. It creates these distortions in the markets. And housing price bubble, thought we learned it during the mid 2000s, but I don't think we learned it then. Maybe we'll learn it this time. Housing price bubble is not something a nation should be pushing for. You don't want to have home prices be at levels that aren't consistent with people's incomes. You want to have home prices be based on what people can afford, not based on artificial levels, either through manipulating the mortgage rate or through stimulus that drives up demand in the short run. All of that is not a good thing. You want homes to be affordable because you don't want people to be spending an outsized portion of their income on housing, because it's not a productive good. You want them to be able to save, to invest. And if we look at the average percent people who are buying homes today have to spend on a house in terms of their income, you're looking at over 40%. So that comes back to that affordability question. That's why demand is so low, because people simply have to stretch so much. Many are unwilling or unable to do that. So the easiest solution here, let the free markets go to work. Don't get involved on this in the future. I don't have a lot of confidence that's going to be the case, but hopefully we learn some lessons from this experiment. And really, on this money supply thing, this is a huge factor. Again, Fed never talks about it, but let's hope that we don't see another spike higher in the money supply. It's definitely moderated, which has been a good thing, a big driver of lower inflation over the past year, and hopefully that continues. So let's talk about earnings. Better than expected would be the headline, I would say. Certainly in terms of earnings per share growth here, we have 91% of companies reporting in Q2, so almost done with earnings season, and we have 15% year-over-year growth in terms of earnings per share. Pretty good number. Nobody was expecting double digits coming into the quarter, so definitely well above expectations. Breaking, of course, those streaks of negative quarters. We broke that last quarter, so here we have a second consecutive quarter of positive growth. And S&P Dow Jones is forecasting or positive year-over-year growth in Q3 and Q4. If we look at sales per share, up 7% year-over-year. Again, better than expected. People weren't expecting this high a number in terms of sales. So definitely a moderation. We haven't seen, it's kind of leveling off after we had that enormous boost in 2021, the recovery in earnings and then some. So all of the stimulus led to higher revenues, higher profits for companies. And now we're seeing a moderation, 7% though, still pretty strong, still above the rate of inflation over the last year. So if you look at profit margins, this is an interesting thing because a lot of people last year were talking about profit margin compression, and we did see profit margins come down due to that inflation. Companies couldn't keep pace with those rising costs, but we saw a dramatic shift, and we talked about this a lot last year in terms of companies right-sizing, cutting costs, getting leaner, and the result of that, combined with revenues kind of holding up here, is margin expansion. Actually, we're seeing margins go up from 10.9% at the lows last year to 11.9%. So still off the peak from 2021, but perhaps we'll never see that again. But 11.9%, well above that average since 2000. So surprising thing to a lot of people this year to see margins expand this much. And that's just the operating leverage that a lot of companies have. They cut a lot of costs, you get a little boost in terms of revenue, and it goes a long way in terms of the bottom line and the profit margin. So this is the bigger picture look of where earnings are. Still below those Q4 2021 peak levels in terms of operating EPS and GAAP EPS. But the expectation, and it could be wrong, from S&P is that we're going to get there by late this year, early next year. We're going to hit new highs in terms of earnings. Now, I throw out all earnings forecasts because they're almost always wrong, either wrong to the downside or they're overly optimistic. One way or another, they're going to be likely to be wrong. But interesting here, we're not that far off from new highs in terms of S&P 500 earnings. I think a lot of that is being reflected in terms of the stock prices, because the expectation coming into this year is that earnings dip that we saw last year was going to continue, and it hasn't. So that upside surprise, big driver of sentiment, certainly one of the reasons why stocks are doing as well as they are so far this year. Streamflation, this is an interesting one. Wall Street Journal had a piece on this, but if you have a streaming service, and I'm sure that you do because most Americans now have at least one, you're likely noticing a change in the prices in the last few months. But look at this chart here, very interesting, that the average viewership by type now, if we look at traditional television, either cable or broadcast TV, in July, it actually fell below 50% for the first time. So we're seeing this long-term shift away from regular TV and increase, obviously, in streaming. And this has been going on for years, but this year, for the first time, we're seeing the percentage of people watching regular TV, let's call it, dip below 50%, and streaming just taking a bigger and bigger share. So what's going on in terms of streamflation? Well, if you have one of these services, you notice that they've bumped up the price this year, pretty much across the board. We're seeing increases. Wall Street Journal said the average was around 25%. So some of them are more, some of them are less. But what started out as pretty cheap in terms of people these companies trying to get people to sign up for the services, so they price them very low. Well, they're very quickly increasing in terms of that monthly cost. And if we look at, this is an interesting one here, if we look at what's happened in the last decade, so big shift in terms of American spending. So this is showing you the average monthly spend on streaming services. It's pretty much tripled in the last decade here, from $10 a month to $30 a month on average. And that's a function of our higher prices, of course, but also that people now have more than one streaming service. So the content's been so good on so many different platforms that you feel like, I can't just have Netflix. I have to have Netflix and Hulu, and I may have to add HBO Max, and I think it's just called Max now. But now the average person who has a streaming service has 4 of them. So it's very quickly escalated, and I assume a lot of these people have disconnected, at least partially, their broadcast TV to right size their costs. But this is kind of a secular trend. I don't think it's changing, and you're seeing more and more of these streaming services popping up all the time. It's kind of the golden age of content. And what these cost increases have done for these companies is they're starting to see customers push back, and so they're trying to figure out, how do we still have subscriber growth and maintain pricing at a level where we're not going to continue to lose money. And so what a lot of them are doing now is offering services with ads at a lower price point, and then one without ads at a higher price point. So you're seeing more companies doing that. Seems to be popular with people, where they can get that lower priced option if they choose, and not have as big of an increase. So why are streaming companies raising prices? Well, many of them have been losing money for a number of years, spending just a ton of money on content. This is showing you operating income for Disney and Comcast, which has Peacock and Paramount and Warner Brothers. And you can see they've running losses for a long time. Netflix has an operating profit, but not a huge one. And obviously their subscriber growth has slowed significantly, and they just invested a ton in content over the years. So all of them now, I think they're likely saying, well, we have the viewers hooked to a certain extent, so we're going to kind of test out that pricing power. And I think in the article, the Wall Street Journal pointed to Disney, and they hiked their prices a few dollars a month for their Disney Plus. And they didn't see very much at all in terms of subscribers leaving. And so that to them was a signal that they could probably raise prices even more. So And I want to end, as I always do, with a positive trend here. This is a secular trend that's been going on for decades, and I think it's likely to continue. Up and to the right, US e commerce sales as a percentage of total sales. So, 1999, less than 1% of sales came from e commerce, now over 15%. I'm viewing this as a positive for most people just because of the convenience factor, the fact that you can buy almost anything and get it nearly immediately. Many things you can get same day is just incredible. Frees up your time to do other things that you'd rather be doing. If you still want to go to the store, you can go there, but you can find items that you wouldn't have been able to find before at better prices and faster than you ever did before. So certainly a good thing for many people, a good thing for people like me who don't like to shop in the store. And we're seeing this across the board from companies like Nike, in terms of direct to consumer and e-commerce sales, to every single company has become a digital company to a certain extent. It doesn't matter if you're a supermarket where people still like to go and shop in person. I can understand that, but they have to offer that option of either picking up in person and ordering online, or just delivery, because people have gotten used to the convenience of it, and the time saving factor is huge. So we'll end it right there. Thanks everyone for joining me. Have a great week. If you like the content, as always, subscribe to the channel, and I'll see you next time on the Week in Charts.